Is your mutual fund portfolio or your stock portfolio in the red? That means your portfolio is showing negative returns on various stocks and mutual funds. Then this video is for you, because in this video, I'll show you why that negative is actually an asset for this year and maybe for the future years on two counts. And that's what this video is all about. Hi, I'm Franky Fernandes. I'm uh, I'm the founder of Harmony and Money. It's a community for families to build their wealth, but also build their relationship, which is so important for your life now and in the future. I'm a certified financial planner. I'm also a relationship coach, and I help families who are in distress, who are troubled because of money, and I help them rebuild their relationship. You'll find a lot of these details of my community and the courses in this description. So now let's get into this short video, and you must watch this video full and take quick action this week, because only then it will benefit you. Of course, this video also has value for the future, but in the next few days, this will help you, because this situation that we are into is not something that happens often. So let's get into this video. First, let's begin with the basic thing about what are these capital gains and losses. Now, in this video, we will restrict only to stocks and equity mutual funds. And what are equity mutual funds? Any mutual fund which have got at least exposure of 65% to equity stocks, right? So what are these capital gains and losses? I know a lot of you watching this may know this. You can skip this part. Basically, and this is for those who do not know. So basically, every time you sell any stock or mutual fund, if you make a gain, if you make a capital gain, that is subject to taxes. There are two types of capital gains. One is short-term capital gains and one is long-term capital gains, and gains and losses both. Short-term is when you withdraw or you redeem or you sell less than 12, that's 12 months or less. And long-term is beyond 12 months. Now, for short-term gains, you have to pay 20% taxes. And for long-term capital gains, you have to pay 12.5% taxes over and above 1,25,000 capital gains, which means up to 1,25,000, you don't get taxed. Beyond that, you get taxed at 12.5%, which means if you've purchased, for example, stocks, mutual funds up to maybe for 10 lakh rupees, and you make 11 lakh 25,000 beyond 12 months, you pay zero taxes. If it is less than 12 months, you have paid 20% taxes. Now, if you probably from 10 lakhs, it has become 12 lakhs. That means on that 75,000, you have to pay 12.5% taxes. Now, in this video, we will talk and emphasize more on the losses, right? And that is what this video is all about. Now, what if you have in your portfolio stocks and equity mutual funds, and when you look at them, you see red, that means negative. So this is the best opportunity to sell them and get rid of them. And why? There are two important things here, two important reasons. Number one, you book losses, and it's not negative. Booking capital losses is not negative. I'll talk about it. Why? So that is the first benefit. Second benefit is that you can take these sales proceeds and invest into good quality stocks and funds. Because although we feel bad about this war, we all want this war to end. Markets have fallen so much that this is the best time to invest. And if you do not have cash, the best way to invest is withdraw from the bad funds or stocks and invest in the good funds. Now, what happens? Now, when you look at negative, it feels actually negative, like you feel bad, especially when you see it in your portfolio. But then if you sell your funds or stocks, it is not negative. You're creating an asset for the future. How is it? Because Capital losses, both short term and long term, can be carried forward up to 8 years, which means in the coming years, if you sell equity, mutual funds, or stocks and you make gains, you can set it off. In fact, even in this year, if you have made gains and if you sell now, you can actually set it off and you don't pay any taxes. In fact, in the future, why I said it is an asset? Because your capital gains which you make later on in the years, probably you've made a lot of gains and you want to withdraw, you can set it off against this losses which you book now. And this opportunity you never get, because wars don't happen often. And in the future, such an opportunity where after 2 3 years, after long term, you see losses in your portfolio, the chances are very low. So this is the opportunity to actually book losses. And it's also called as, the technical term is the loss harvesting, where you are harvesting and you are taking advantage and you are saving your taxes. And the best part is here, you not only get rid of your wrong funds or wrong categories. Probably you should have bought a mid cap and you've got large cap, or you should have bought small caps, or if you should have bought large cap but you've got small caps. So this is the time to change your category and also the funds. When you buy the new funds, right, the good quality funds, in the next several years, they will give you far better returns. So it's a great opportunity and you must take advantage of this. But is there any catch here? Are there any risks? Yes, and I'm going to explain to you shortly. But before that, so hang on, watch this full video. But before we get into the risks, you may have some questions like, what if I have good funds and they are also negative? Can I sell them? Yes, why not? If they are negative, they are good funds, you can sell them. Yes, you can sell and you can use these losses again in the coming years and you can make gains. What if you have good funds, or maybe even not the good funds, but they're showing gains? Can you sell and take advantage? Yes, up to 1,25,000, you can actually book profits and not pay taxes. Now, let's think of the risk. Now, it sounds very good on paper that you get rid of your old funds and then you invest in new funds. But the catch here is that when you redeem your equity funds, there is a T+3 settlement, which means you will receive money 3 days later in your bank. Which means if today you do it, if today is T+3, which means 1, 2, 3, 3 days later you will get into your bank. And only then you can redeploy, reinvest into a good fund. And what if during these 3 4 days, the markets keep going up? You lose on that. That means you will gain on the taxes in the future, which is probably 12.5%. But here you may lose because of the rally. So there is a risk here. So how do you mitigate this risk? Do not depend on the sales proceeds of these equities. Ensure that you have enough money in your bank or maybe FD, which you can immediately invest in a day or two before the market rallies and goes up. Yes, if the market keeps falling down, it's an advantage for you. You can invest probably at a lower value. But then we don't know markets. We cannot time the market. So the best thing is that if you're selling equity funds worth 5 lakh rupees, ensure that you have 5 lakh in your bank or FD, which you can immediately invest maybe tomorrow or the same day in the new funds. Or if you want to invest in the same fund, even that you can do. But right, again, as I mentioned, we are talking about funds which are not good and you want to invest in the new funds. So this is one way so that you don't lose. So this is a big risk. Now, another way of doing this is if you have debt mutual funds, just like FDs, even those you can sell because that money will come T+1 or 2 max, and which you can invest. But again, if you liquidate FDs and debt funds, the gains that you have in those will be added to your income, which means you will have to pay income tax on the highest slab. If you're in the 30% slab or 20% slab, you have to pay taxes on that. So there is a catch. The best is if you have funds lying in emergency funds like cash or or low interest products, you can actually redeploy. So these are the basic the risks that we have here when you do this. So let me quickly summarize. So if you have funds or stocks in your portfolio which are negative, and they're also not good quality funds or stocks, sell them now and book those losses, set it off against this year's gains or the next 8-year gains. That is the advantage. And use that money and invest in better performing stocks or funds which you always wanted. Of course, the catch here is that you may miss the rally if the market keeps going up. But if the market keeps going down and you feel that the war is still there and there are chances that you can get at a lower price, you gain both ways. But we cannot time the market, we don't know. And as I mentioned, that there are short-term gains, short-term capital gains, long-term capital gains. And one point to note here is that short-term capital losses can be set off against short-term capital gains and long-term capital gains. But long-term capital gain losses cannot be set off against short-term. It can be only set off against long-term capital gains. Hope this is useful. Hope you found this short video useful. But one disclaimer here, please consult your advisor. This video is purely for educational purpose. This is just to explain to you the concept. One way you learn, you gain knowledge, and you can use this knowledge not just now, even in the future years, even during the year you can use effectively and still gain. But please consult your advisor before making a call. If you're a direct investor, yes, read up, listen to others, read up, go on various websites, check, and then make this decision. But if you are, if your mutual funds have been sold to you by a distributor or you're consulting an RIA, please talk to them before making this, taking this decision, because this has certain risks. I just did this today myself. I also am trying this for myself, and hence I thought I would share this to you. If you've liked this video, just give me a thumbs up and let me know in the comments why you liked, or if you don't like it, please let me know what more I could have done. This is, as I said, this is a short video. Quickly and take action right now in this week, because there could be bank holidays. You may not get all the money quickly. There are bank holidays, and so you may not be able to take that advantage. Let's hope that this war ends soon and we'll once again see our portfolio getting into the green. All the best.